Hi, Barbara Friedberg here. Today we're going to be talking about how to invest in a rising interest rate environment. As you can see from this chart, interest rates were near zero, actually, for about 15 years. And then in April 2022, they started to go up. And they have been traveling up until today. They are near the 5% mark. Now, a lot of people who have noticed that during the last 15 years, interest rates have hovered around zero are a little bit freaked out by the 5% interest rates because it seems so high. Well, the 5% interest rate is actually the average Fed funds rate for about the last 100 plus years. So we're really in more of a normal interest rate environment. But it's going to take some getting used to for investors. And also for those of us who have debt, it's a wake up call that we might want to trim some of our debt because our interest payments, our mortgage payments, the rates we pay on credit card debt have skyrocketed. So now that interest rates are nearing more of a common or typical range, how should we invest? How should we take advantage of these higher interest rates? And today, the Federal Open Market Committee, which is the decider of the Federal Reserve Bank on target interest rates, has had quite a few increases, as you can see, since April 22nd, and we are now hovering around 5%. So let's dig in and figure out what are the best investments for the rising interest rate environment and also for a higher interest rate environment. Now, savers and those with cash are very, very happy today because we have gotten a little bit sick and tired of receiving less than 1% return on our cash. And today you can get nearly 5% very safe interest rates on your cash, which is such a relief for those of us that have cash that we need to keep in a cash type account. Those of us that have money for an emergency fund or have money put away for a vacation or short-term needs for up to the next 2 years or so, because it's too risky to put that cash into more volatile stock investments. So our first best investment for rising rate interest rate environment are cash and cash equivalents. Now, your savings account at your bank may not pay near 5%, but many, many savings accounts offer what is a high yield savings account. I know my bank now is paying about 4.88% for that high yield savings account. You have to ask for it, you have to look for it because banks would prefer to pay you lower interest rates. Certificates of deposit are a type of banking product that you can buy both at your bank or at an investment brokerage firm, and they pay up to 5% today as well. You may need to tie your money up for 3, 6, 12, 18 months, but if you need to take your money out earlier, all you'll do is sacrifice maybe 3 months of interest payments, which is a small price to pay for receiving these robust yields today. Now, high yield money market mutual funds, they have like a 5 letter ticker symbol. I'm invested in Schwab's, Fidelity, most of the major mutual fund families have these type of investments, and they are invested in very, very short-term debt so that the interest rates they can pay you rise as quickly as the federal funds interest rate rises. So right now I'm getting near 5% on the money that is invested in my SWVXX or Schwab Money Market Fund. Another short-term cash equivalent are treasury bills. You're not going to hear about these from your financial planner because they get no commission or really no benefit from investing in these. And your federal government will put out these bills at auction from up to a couple of days, their duration or their maturity, through about a year. And you can buy these at treasurydirect.gov or you can buy them at most financial brokerage firms. They are a very, very safe investment because they're backed by the US government. And another handy benefit of investing in treasury bills is that the interest that you receive is exempt from state and local taxes. A final cash and cash equivalent investment are commercial paper or very ultra short debt ETFs. Those type of bond funds or debt funds have maturities very short, almost the same as the high yield money market mutual funds. So you get a relatively stable principal value of your invested capital with higher interest rates as interest rates go up. And all of these cash and cash equivalent Investments are great when interest rates are going up because you'll benefit very quickly when the Fed raises rates. These types of investments will also increase your interest payments, with the exception of a certificate of deposit. And you will need to purchase a new one to get the new higher rate. So why should you invest in these cash and cash equivalents? Well, they're a really nice stabilizer for your investment portfolio. They're also great for those 3 to 6 month emergency funds, money that you need liquid for when your hot water heater goes out, your air conditioner goes out, your car needs a repair. Unfortunately, just this week, I found out we need to replace our air conditioner and our hot water heater. So I am very happy to have some cash in our emergency fund. They're also great for money that you'll need within a year or two because you don't want to worry about that money that you're saving for vacation to drop in value if it's invested in the stock market. One of my favorite robo-advisors and high yield cash accounts is available through Wealthfront Save. You can click on this link, and if you do, I will get a small commission that will go to fund this channel to sign up for this 4.8% high yield cash fund. That was a lot. Okay, let's get on to short-term bond or debt funds. A bond is typically just a loan to the issuer. You lend them money, and in return for that loan, they pay you a certain interest rate. A short-term bond fund invests in very short maturity bonds. It's a type of mutual fund or an exchange-traded ETF that has maturities typically less than 3 years. They might own various debt securities such as government or corporate bonds. And because they're a little longer maturities than your cash equivalents, you will find a little bit of variability in principal of your principal investment amount. But in exchange for that variability, you will typically get a higher yield. It's a solid way to capture current and rising cash flow from low risk bonds. And here's where the bond tutorial comes in. Bond funds have an inverse relationship to interest rates. So when interest rates go up, short-term bond funds will drop just a smidge in value. Now, that's why we're not recommending long-term bond funds, because when interest rates go up, those are going to decline in value just a little bit more. But there is another hidden benefit to investing in bond funds right now. There's a lot of conversation that we're near a peak in interest rates. And once the Fed starts to reverse course and starts to lower rates, your bond funds will go up in value. So that's something to keep in mind when you're investing in bond funds. When interest rates rise, the principal value of your bond fund will decline. Shorter bond funds decline less in value than longer term bond funds. And here we have a little more detailed description of this. And you can read this in the article that I will link below. So why should you invest in short-term bond funds? They're useful for intermediate term financial goals or for the fixed income portion of a diversified investment portfolio. If you're like me, you don't want all of your investments in stocks because despite the fact that they have outperformed the returns of bonds over many years and over the long term have averaged around a 9% per year return, during shorter periods of time, stock market returns are volatile. I'm a conservative investor. I like to balance my stock holdings with an allocation to bonds because during those years, like in 2022, well, 2022 is a bad example because that was the only year in many decades where stock and bond funds declined. But in general, when your stock funds decline, your bond funds and definitely your cash will hold their value. And so that'll curtail the losses that you might receive during a declining stock market environment. So, long-winded answer. So that's why you want to have some bonds in your investment portfolio. Now, financial stocks or financial sector funds can also benefit from higher interest rates. Think about the bank. And we have seen it today, if you are a borrower, mortgage rates have gone up quite a bit, actually tripled since a couple of years ago. And other loans, credit card debt has gone up as well. So banks make their money on the difference between the payments they make to you for your savings or cash accounts and the money they receive from borrowers. And typically, as interest rates go up, they're more apt to increase their loan rates, causing them to earn a lot more money from loan payments than they are at increasing their payments to savers. And that's called the spread. So if they're paying you, let's say 4 or 5%, but they're charging a borrower 8% for a mortgage loan or 10% for a riskier loan, the bank's profit is that difference between that 5% savings interest rate they're paying you and the amount of money that they are receiving. Financial stocks thereby tend to be more profitable when interest rates are higher and interest rates are rising. Now, floating rate bond funds are a nice product, especially when interest rates are rising, because they have interest rates that reset periodically, typically based on a short-term benchmark interest rate. So consequently, as their interest rates rise, you will receive higher payments and greater cash flow. Now, a drawback to these floating rate bond funds is that when yields decline, of course, your cash flow will tend to drop as well. So I'm going to give you a tip. When you think we're nearing the peak of the interest rates, you want to transition the fixed income portion of your portfolio into intermediate term bonds. And that's because of what I told you before. There's an inverse relationship between interest rates and bond funds. And in an intermediate term bond fund, when interest rates start to go down, the actual value of your fund will appreciate or go up. So it's also important to know that there is no investment that is perfectly risk-free, and there is no guarantees on any investing that it's going to perform in the way that it is designed. Now, really safe environments are your treasury bills. And these are issued by the US government, and they come in maturities of a few days to a year. You can buy them from the treasurydirect.gov, or you can buy them from your investment brokerage firm. And you will get typically right now the 13 and 26-week treasury bills are paying over 5% interest. If you go out 10 years, you'll get close to that 5% interest as well. So these are very, very safe. They are backed by the US government, and they are tax exempt from state and local taxes. So if you live in a high tax state like New York, New Jersey, California, these are a wonderful investment to check out for your short-term cash needs. So I'll show you a couple other questions I answer. You can read the article to learn more. How do interest rates affect my savings? What are inflation-protected investments? And how do interest rates affect bonds? We've already covered that. So the wrap up is, now is the time to make sure you are getting the highest return on your cash investments. And it's easy to do. Ask your bank for a higher yield account, invest in treasury bills, short-term bond funds, and you will benefit from the higher interest rates today. And remember, if you have a lot of debt, now is a great time to pay it off, because those interest rates are not your friend. Higher interest rates are not great for debt holders. So I am Barbara Friedberg. Thank you so much for listening. If you do, click on the Wealthfront link. We may get a commission that helps to fund this channel. And if you found this video useful or helpful, please subscribe below, leave a comment, and I will be happy to respond. See you next time. Bye.